Good afternoon. This is Ken Long from Tortoise Capital, and I want to talk a little bit about my routines for preparing for the daily trade. I want to emphasize how important I think it is to be routinely ready to engage in trading each day. It's typical of military planning to start with what we call actions on the objective, or what it is that we are ultimately trying to accomplish. We know that we have to get there first, we have to do a lot of things along the way, but we want to make sure that if there's only one thing we get done correct in planning, it's to have a good plan for actions on the objective. And so for me, the purpose of all my preparation, the objective, is to be what I call ready to trade. And so if we see this vertical blue line as the point in time where the market opens, when I cross that line, I want to be in a state I call ready to trade. And when I am ready to trade, then I can execute my trading plan for today uh, by being in the zero state, which I mean is a perfect balance between excitement and calm. I have just enough energy to be focused and to really be paying attention, but not so much that I'm draining my emotional bank account. I'm letting neither fear nor greed dominate me. I have an inner confidence and ready calmness to execute properly, and so that I don't let my emotions get in the way of executing the trade the way I've rehearsed. I want to be able to focus on what's happening right now with price and not let my beliefs about what the market should do or could do or might do or what I thought it could do or my predictions about what it could do to get in the way of actually seeing directly what the price action and the indicators are showing. I want to be able to focus on what's working, so I need to have a broad enough approach that gives me many things to choose from so that something is working, so that I can look exactly at that thing and trade what's moving as opposed to waiting around or trying to force things to work. I want to see what's working right now. I'm going to use what I call a logic chain in order to uh, move me from an assessment of the market towards the sectors that are outperforming and then to the individual components of sectors that are working, so that if I have some of those prepared, I can find something that is benefiting from all three: market action, sector action, and target action. The logic chain is how I link those different targets together and allows me to quickly find on my radar screen those targets that are best postured to help me meet my objectives. And so when I'm executing, I'm going to have a number of strategies to work intraday. Things like the frog system, the regression line crossover framework, and trades. Intraday relative strength, which I measure in certain ways. I may use core and turbo strategies where I have swing trade positions that are open, and then during the day when price is moving in a particular direction better than anything else, I can add an additional intraday piece and then have the benefit of being prepared for the swing trade and have it carry over to intraday improvements as well, core and turbo. For reframing, I'm talking about how to look at current price action through the regression line crossover and frog framework, and then find ways to frame trades that are 2 to 1 reward to risk in a manageable way, and then take into account the time of day and the expected price movements that occur at different times in the day. The opening 30 minutes behave differently than the next 2 hours, which behaves differently than the lunchtime trade, which behaves differently than the afternoon trade, and then into the closing half an hour. So all of those time frames have characteristics of their own, and I need to be aware of that as a context for interpreting market action. So if I am prepared to trade, if I am ready to trade, then I can execute all of those elements: zero state, focus on what's happening and what's working with my logic chain, and picking the most appropriate strategy for that time period and those targets. So working backwards from ready to trade, what does that mean? Well, backing up, it means that my platform and dashboard are properly prepared and set up with backups, and that the visual display of information is geared towards my dashboard requirements. They got to be simple yet comprehensive and allow me to execute without spending an awful lot of time thinking about what the speedometer means. So if you think about how you drive with unconscious competence, the dashboard indicators are actually a pretty simple set of guidance tools that allow you to perform a pretty complex task, driving an automobile down the road. And so I want my platform and dashboard to be prepared so I can execute properly. I want my mental state to be set in the zero state, so I've got to do some visualizations and preparations, think about the things that are important, be well rested, well fed, relaxed, having done my meditations, and then get my game face on prior to the opening bell. That's getting my mental state ready. I will have had to complete a rehearsal of all the things on my logic chain and the trade strategies keyed towards different times of the day, and visualized how I was going to execute different contingencies. I have to have monitored the gap statistic and see where the market is going to open with respect to where it closed, because we have some indicators that tell us what kind of a day we might see based on the size and the direction of the gap. It tells me things like the larger the gap, the larger the follow through for the rest of the day. And so by knowing the gap stat going into the opening, I am ready to trade. Finally, the market condition. I need a short-term and long-term vision of that so that I have market context for interpreting price action and the kinds of follow-throughs we can expect to see. Uh, when I think of market condition, then I have to drill down a little deeper and say that my view of market condition is a function of my market classification system, what I call the slope stat, or an analysis of the slope characteristics of the regression line for the market. Based on what that slope is and its recent context, I have some opinions about what kind of market it is. The NDX10 is the tortoise index, uh, a form of oscillator that we've developed to allow us to characterize the behavior of the last 10 days. The risk Z, another indicator we've adapted from some academic literature on volatility and the VIX, that tells us what kinds of follow-throughs we can expect in terms of the volatility trade. Weekly RSI and sector conditions, two additional measures that allow us to look at long-term market conditions, and understanding the relative strength of different segments of the market so that we can maybe take advantage of momentum or reversion to the mean if something has exceeded its normal excursions. So all of those things go into my assessment of market condition, which I need to carry forward into the new day to help guide some decision making. Well, going backwards from the rehearsal now, I need to have computed my trade frames with key prices for each of my targets. And so by trade frame, I mean a disciplined, systematic, structured way of identifying critical price levels that tell me what kinds of behaviors to expect or to not be surprised from when price gets there. Trade frames allow me to anticipate critical moments in the market for support and resistance and maybe major turning points, and have information content. Where do those trade frames come from? Those key prices, the gap statistic I've talked about. Performance statistics we call the range stat and the fail stat, and the signal to noise ratio of the target. The holding z-score, in other words, how many over the last 10 days or the last X day period, how does the recent performance compare against the historical performance over those time periods, so that we can judge whether or not the target is in an exceptional or a normal condition psychologically. The highs of the day and the low of the day are an important part of my trade framing, because important behavior happens when price gets near yesterday's high or low. And then the 10-day high or low sets up a framework for interpreting swing trade patterns, and which we use for computing swing trade support and resistance levels. So all of those assessments go into establishing key price levels for all my trade frames. Well, what are the targets that we're framing our trades on? Well, it comes from the consolidated watch list. And I have three sources of candidates to trade for my strategies. The first, a set of candidates from new swing trade systems or strategies. These are things that have tested out in back testing and then perform well in forward testing. These are patterns and systems and signals that tell us we ought to be very interested in that target because there's a good chance of having an exceptionally large move over the next 3 to 5 days. And so we want to be able to tap into that movement when it occurs, beginning with day one. And so, candidates for new swing trade systems, we know those things can last 3 to 5 days. We have something to pay a special attention to for the next week or so. Similarly, continuation patterns from yesterday, and that could have been any trade for any reason that worked out well during the day and has not yet hit its swing trade exit signal. We now would expect some additional momentum or perhaps a reversion to the mean to occur the following day with a large range move. So continuation patterns from yesterday are important because we managed them during the day. We had a set of key price levels for them already, and now we can simply update our trade frame, and then we get some efficiency by maintaining connection to that trade narrative. And then finally, the third source, the standard set of tradables, by which I mean things that I am always going to be prepared to trade because they have the following qualities. Now, they're key to major market indices. They're very liquid. They have a lot of trading volume. They have narrow bid-ask spreads, and um, uh, they behave properly intraday, meaning that there is continuous trading and no gaps, and there's always a trade to be made. So those are the three sources of candidate targets that make it to my consolidated watch list, which we then feed forward into key frames. When we think about continuation patterns from yesterday's trade, what that really means is that the end of the trade day, indicated by this blue line, when the market closes, we have to conduct a daily after action review as part of the dozen tasks of trading. You have to assess what happened, what worked, update our trade journal, and then forgive ourselves for the trading that we did and have gratitude for the fact that we're alive and have an opportunity to engage. And that emotional uh, exercise there helps me clear and be ready to do all the work that's described in here. So the after action review is the source of continuation patterns from yesterday. The candidates from new swing trade systems or strategies, I've listed a dozen or so here. Channeling, overreaction, triple screens, washouts, 5 days down, 551Ws, etc. All of these are standalone systems and strategies that have given us favorable reward to risk trades, low risk ideas, and that can generate signals that happen to work not only in the swing trade time frame, but also day to day. We think of that as swing trading one day at a time. Well, if those are the signals that generate new candidates and the after action review are the continuation patterns, and then the standard set of tradables, all of those move into generating the watch list. So if we think about preparation happening from the moment that the market closes, we realize that we are trying to trade in the zero state by focusing on what's happening, what's working, using the logic chain of price uh, uh, sensing and detecting and analyzing and decision making to get us into what's working using the frog and RLCO frameworks and the various techniques I've talked about, and taking notes for our trading journal as we go along, because that's actually preparation for the next day and for improving our trading practice. So going forward, then, we trade up until the point we run out of one of four things. We run out of time, money, will, or targets. We have to have all four of those things. We have to have a target. We have to have the time left in the day to be able to trade it. We have to have the capital in the account to be able to trade it. And then we have to have the willpower to be able to trade in the right state of mind, with the right degree of focus and attention and care for what it is that we're doing. If any one of those four isn't available, then we're not prepared to trade. Then when the market closes, we then go through our after action report and our emotional clearing and then start generating the new trading plan. And so if we think of this as a function of planning, which identifies our targets, preparing, which means that we go through and build the trade frames for each one of those, we can then be prepared to execute the next day, and at the open we can judge whether or not we are ready to trade. Now, of course, there's a lot more that goes into each one of these boxes than I've been able to talk to, but that's the general strategy that I use towards preparing for the next day's trade, which includes taking care of business each and every day and closing the day out well, running my reports, getting into the right mindset, and then doing the work that makes me ready to trade the following day. So um, that's that's my daily preparation ritual and my flow chart for my process. Hopefully, it will give you some insights that uh, um, you might find useful. So, this is Ken Long from Tortoise Capital. Take good care.